Hi guys, so welcome back to the video. So this is the video that you've been waiting for so patiently. So yeah, finally it's here. So what I've done is I went through entire syllabus and I divided the entire parts into 5 main concepts. Okay, and I made these videos concept based instead of lecture based. So I'll do one concept, then do one sum related to that concept, and so on. So there will be 3 videos on each concept, and then 2 other videos. So there will be 5 concepts that I'll cover. And if you watch all these 5, hopefully the entire syllabus will, not hopefully, the entire syllabus will be okay. Now another thing is that I'll try and segregate the video into first the concept part and then the sum, so that if you know the concept, you need not watch that again, and you can directly skip to the video, to the problems, the questions that are given. But I suggest that you watch the concept also, so that you get refreshed, because it was done a lot of time ago. Okay, so let's get started with the first one. So the first question here is cost forecasting. So how do you do the cost forecasting? So I'll read out the question, and then let's go. I'll use this sum. This is problem number 1 in the practice problem that was given. And there are 3 methods of cost forecasting that sir mentioned in class, and I'll use the sum to explain all 3 methods. Now, let's read the question first. Okay, so it says that given below is 2013 to 15 data for ABC Corporation. In 2014, the company increases salaries by 10%. No more changes expected in the next 3 years. Due to the good earnings, the company doubled its dividend in 2015. It is expected to continue at the same level for a few years before planning to increase again. Forecasts for its revenue and retained earnings for 2000 forecast its revenue and retained earnings for 2016. Write all the numbers in the cells under 2016 and try to give 2 forecasts for the initial variables, each backed by clear logic. Okay. Now let's see this. Basically, what's given is revenue, salary, cost of goods sold. So revenue minus salary minus cost of goods sold will be earning before tax. You reduce tax at 40%, that will give you earning after tax. After that, you give dividend to your shareholders, and whatever is remaining is called retained earnings. So this is the entire flow. Now let's start with the revenue first. So basically, here you can see that there is a straight line increase in revenue. So it says 120, 150, 180. So it's every year it's increasing by 30. So directly you can say that for the 2016 period, the increase will be by 30 again. So equal to 180 plus 30. Okay, so that's 210. Now here it was given straight line, so it's fine. It could have been that first year is 120, second year is 144, third year is so here what was said that, okay, let's say the example was like this, that first year is 120, second is 144, third year is 172.8. So you can see that there is a growth of 20% each year. So what you'll do is equal to this into 1.2. So it will give you a 20% growth in the next year. So that you have to figure out from the question, what is the pattern of revenue. If you can't figure out the pattern of revenue, then whichever way you're calculating cost of goods sold, in that way only you'll try to figure it out. So generally, I don't think the revenue figure will be that complicated in the example. So let's take the assumption of whatever was given, and let's take its straight line increase 30, so equal to 180 plus 30. Now salary, it said that the company increases salary in 2014 by 10%. No more changes expected. So it changed it in 2014, no more changes expected. It will be 22 again. Cost of goods sold, no more changes expected due to company's dividend doubled. Okay, that's fine. Nothing is said about cost of goods sold. Now there are 3 methods that are there to forecast any cost. So the first method is as a percentage of sales. So for this method, what we do is find out that cost. So this cost could be cost of goods sold, this could be wages, that could be labor cost, it could be any cost. Okay, So we find out that cost as a percentage of sales equal to 94 divided by 120. So this will give you a percentage. Similarly, calculate for the other two. So you see, first one is a 78, then 81, then 79. Now, basically what you do is calculate the average of these three and give you 80%. Now, what this says is that your cost this year should be 80%. So 210 into 80%. So 167. Now, earning before tax is basically equal to 210 minus salary minus cost of goods sold is 21. What is tax? Is equal to this one into 40%. And whatever remains, this one minus this one, 12.6 is the earning after tax. And dividend, again dividend, it said in the question that due to good earnings, the company doubled its dividend in 2015 is expected to continue at that level for a few years before increasing again. So it's saying that it should continue at 6. And so whatever is remaining, 12.6 minus 6 is 6.6. Now 6.6, and so here dividend, what they could have said is that the increase in 2015 is temporary in nature and the company will continue to pay in the same rate as before. In that case, you would have taken 3. Okay. So this is the first method of assumption. So here you've used the forecast as percentage of sales, average percentage of sales. Now for the second method is called incremental change. Now what incremental change does is basically calculate the incremental change in revenue and incremental change in net cost. So here incremental change in revenue is basically 150 minus 120. So it's, so what you can directly do, okay. So what you can directly do over here is take the incremental changes in revenue. So revenue has increased by 150 minus 120, so 30 rupees. I'll just put this in center line. Yeah, so revenue has increased by 30 rupees and cost of goods sold has increased by 122 minus 94, so 28 rupees. So okay, let's do this like this. Let's say change in COGS and change in revenue. So change in cost. So change in cost is equal to 122 minus COGS, and change in revenue is 150 minus 120. So you find a percentage of that. So divided by 93. Okay. Now you copy that to the right, and so you'll get next year it's increased by, the cost has increased by 20 and the revenue has increased by 30. So 67% increase. Now you take the average of this. So the average comes out to again 80%. So basically what it says is whatever the change in sales will be this year, the change in cost of goods sold will be 80% of that. So equal to, so this year again, here we are assuming that it's increasing by 30 rupees again. So 210. So 210 means 30 rupees increase in sales. So 30 rupees increment in sales, 80% of that would be equal to 24. So we are assuming that cost of goods sold would be increasing by 142 plus 24. And salary will stay the same because it said in the question it will not increase. So now this minus this is my EBT into 40% is my this minus 13.2 dividend would stay the same, and so whatever remains is my retained earnings. Okay, so I hope I didn't go too fast. Main thing is you have to predict this one 110, and you have to predict this one, and this is the COGS is the thing that you have to change. You have to calculate and find. So this in this question it's COGS. In other questions it could be labor cost, it could be wages, anything. Okay, now the third method is a little different, and so this basically uses an Excel function called intercept. So you remember the like slope and intercept thing, click on the graph. So Excel directly uses a function to calculate that same. So the function is equal to intercept, and first you take the cost. So you take the 3 years cost, but yeah, take the 3-year cost, then comma, and then take the 3-year sales and close the bracket. You'll get the intercept value. Again, take the slope. For the slope, again take the cost and take the sales. Sorry, equal to slope, the cost, take the sales. Okay, so the intercept is coming at minus 0.66, and this is coming at 0.8. Now the value, the formula to get y is equal to a plus bx. So here it would be equal to whatever is my sales would be x, and y could be the COGS. So to calculate that, we'll do equal to intercept plus slope into sales. So let me put the sales first. So sales again would be 210. So then you see when you put 210 as a sales using the same assumption, that is the value of intercept that you get. Just put the bracket to check. Yeah. So A is the intercept plus bx. So this is the sales into this slope, and this would again stay the same. So I can copy the remaining thing from here. Yeah, so you can see that here it copies the same thing. So again, EBT is this minus this minus this. The tax is 40% and dividend is 6. Using the 3 methods. So here only 2 methods were asked, but if you use all the 3 methods, so ideally you should show all the calculations and everything, but maybe you can do it in a shortcut manner during the exam and not show all the steps. Okay, see now you can figure out on your own that using every method here, these are the two values. Sales is the same. You can see the COGS is changing every year, because of which your retained earnings is different in each method. Okay, now whichever is the method is the most accurate, actually based on an assumption and based on the way the sales changes. So in the question, if a question like this comes, firstly determine the change in the revenue, and then based on any two method you can use this. Again, I've written the formula and I'll share this Excel sheet at the end of the video, and so that you can use this equal to intercept, cost row, sales row, equal to slope, cost row, sales row. But so these are the 3 forecasting methods that are there. Okay, so I'll end the video here, and then I'll move on to the sales term question in the next video. Okay, so yeah, hopefully this is a short video. I think next one is a little more complicated. So please keep watching, and hopefully at the end of all these videos, it should be done. You don't have to do anything else.